All right, so welcome everybody to the Deep Dives. And today we're going to be taking a look at something pretty huge that's been happening.
It's certainly been making waves.
Yeah, a lot of people are talking about it and wondering, like, how is this going to affect me, my wallet, my day-to-day life? And we're talking about the tariffs that President Trump just announced on April 2nd, 2025.
Big news.
Big news. And we're going to be taking a deep dive into this, and we'll be using an initial analysis from John White, who's the president of Financial Guideposts, as our starting point to kind of see, like, okay, how is this going to actually affect you, the listener?
The individual person.
Yeah, the individual person, and hopefully help you kind of cut through all the noise and figure out, okay, what does this mean for my investments? What does this mean for my retirement plans? And we want to help you avoid making any, like, rash decisions or anything like that.
Panicking.
Yeah, panicking. Exactly.
Okay.
So we've gathered information from a bunch of different sources. We've got news outlets, economic analysts, financial institutions. So
Trying to get that full picture.
as comprehensive a picture as possible.
And I think what's really interesting right off the bat is how kind of big and fast this all happened. April 2nd, some people are calling it Liberation Day.
Wow.
A baseline tariff of 10% was introduced on almost all goods coming into the U.S.
Almost all.
Almost all. And then on top of that, you've got even higher tariffs for certain countries. So China's got a big 34% tariff, the EU 20%, and then even our neighbors, Canada and Mexico, 25%.
So let's talk about the immediate fallout from that, because we saw a pretty intense market reaction. The Dow Jones plunged over 2,200 points. The U.S. stock market overall lost $3.1 trillion in value. And that's the biggest drop we've seen since March 2020.
A scary time.
A very scary time. So, I mean, for you, the investor out there, it really highlights how important it is to have a diversified portfolio.
Yeah.
Is your mix of holdings set up in a way that can handle this kind of volatility?
Yeah. Are you prepared for something like this?
Exactly. And if not, maybe it's a good time to kind of, reevaluate your risk tolerance and how your assets are allocated. Maybe check out some of those resources from Financial Guideposts.
Yeah, definitely. And it's not just about that initial, like, oh, no, the market's dropping, Economists are actually revising their forecasts for how they think the economy is going to grow now. Kathy Bostiancic, the chief economist over at Nationwide, she's now projecting GDP growth for 2025 at just 0.5%.
That's way down from where it was.
Yeah, a big decrease from her earlier 1.5% estimate. So GDP, that's gross domestic product. It's basically the total value of goods and services that a country produces.
Right, the whole pie.
The whole pie, exactly. And a lower forecast means that pie is not going to grow as much. That could affect job creation, business investment.
So that affects me, the listener, the worker.
Exactly. It could have ripple effects on your employment or the returns you get on your investments.
Right.
And Morningstar's even more cautious. They're suggesting that these tariffs could lead to a long-term 1.6% reduction in U.S. GDP.
So a smaller pie overall.
Yeah, we're talking about a shrinking pie, potentially.
And on top of that, we're hearing some pretty serious warnings about a possible recession. J.P. Morgan has actually suggested that these tariffs could be the thing that pushes us into a recession, not just the U.S., but the global economy.
That's a big deal.
That's a big deal.
Yeah.
So how does this all, this big economic, picture, how does this actually translate to what you're going to feel in your everyday life and your finances?
Yeah, that's the big question, right? And the most direct impact we're probably going to see is rising prices. The Yale Budget Lab, they've estimated that these tariffs could add an average of $3,800 to the annual expenses of an American household.
Wow, $3,800 a year or more.
Yeah, think about it for you listening at home. Where would that extra $3,800 really hit you?
Yeah.
When in your budget would you really feel that? Because that gives you a place to start thinking about, okay, where do I need to maybe adjust some spending? Maybe Financial Guideposts can help you think about that.
And it sounds like it's going to hit people with lower incomes even harder.
Yeah, that's right. Households with the lowest incomes could be looking at a loss of almost $980 a year just from these tariffs from April 2nd alone.
Wow.
So it's a big hit. And Josh Stillwagon, who's an economics professor at Babson College, he put it pretty well. He said, everything in the economy will be impacted. There will be an immediate rise in prices that consumers will face as soon as retailers need to replenish their stock. So it's like your groceries, your gas, pretty much everything's going to start creeping up.
So where are we expecting to see the biggest price increases?
Well, there are a few key areas where we could see some really big jumps. Clothing and textiles, for example, they're projected to increase by like 17%. Housing, the cost of a new home could go up by almost $9,200.
Wow. So if you're thinking about buying a house anytime soon,
Yeah, maybe now's the time.
maybe now's the time.
And automobiles, especially imported ones, could be thousands of dollars more expensive. And then, of course, electronics and smartphones, they rely on those global supply chains. And even your regular grocery bills, everyday household items, those are going to go up too. It really seems like there's not much that's going to be left untouched.
So pretty much everything's getting more expensive, and we're already seeing some interesting changes in how people are behaving, almost like a preemptive rush to buy stuff before the prices really jump up.
Exactly. Yeah. We saw a huge jump in auto sales in March, up 11.2%, as people tried to buy imported cars before that 25% tariff hit on April 3rd. And we're starting to see similar trends in other sectors, too. People are trying to get ahead of the curve.
But is that really the best move for everybody? Should everyone be running out to buy stuff right now?
That's a good question, and experts are actually advising against making those kinds of impulsive buying decisions. Ted Rossman from Bankrate, he points out that a lot of people are already dealing with smaller savings and bigger debt loads. So, going out and making a huge purchase or trying to stockpile goods could actually put them in a worse position in the long run.
Right, you could be spending money you don't have just to avoid a potential price increase later.
Exactly. And Financial Guideposts probably has some great advice on how to approach this as part of your overall financial plan.
Yeah.
Making sure you're making smart decisions, not just reacting out of fear.
So what are we expecting to see in terms of overall consumer spending? Because that's obviously a huge driver of the U.S. economy.
Well, it doesn't look good, unfortunately. It looks like consumer spending's going to go down. A recent survey by Morning Consult found that households across all income levels are planning to cut back on spending both essential and non-essential stuff in response to this expected inflation. So,
Makes sense. You're trying to tighten their belts.
yeah, if they're expecting prices to go up, they got to cut back somewhere. And if you look at the numbers, it's pretty stark among households making less than $50,000 a year. 35% of them plan to reduce their spending on groceries.
Wow.
And across all income groups, over 20% said they're going to cut back on dining out and clothing. So
Restaurants are going to be hit hard.
yeah, it seems like people are really bracing for impact.
So we've talked about consumer spending. Let's turn our attention to investors. You mentioned that market turbulence, and it sounds like this isn't just a one-day blip.
That's right. Those big declines we saw in global markets after the tariff announcements, they're probably just the start. We can expect to see more volatility as investors try to figure out what this all means. What are the implications of these new trade measures? And also, how are other countries going to react? We're not operating in a vacuum.
Right.
So all this uncertainty means that it's more important than ever to stay informed and to avoid making emotional decisions about your portfolio. Financial Guideposts, they're a great resource for helping people navigate these kinds of choppy waters.
And speaking of reactions from other countries, we're already seeing some retaliation, right? The U.S. isn't just doing this. Nobody else is responding.
Yeah, exactly. China's already announced their own tariffs, 34% on all goods imported from the U.S., and Canada's planning to impose duties on over $100 billion worth of U.S. products.
So this is an escalating trade war.
It's definitely heating up, and those kinds of countermeasures can further destabilize global markets, making things even more complex and unpredictable for investors.
It all sounds like it could make the inflation situation even worse, especially if it happens at the same time as the economy slows down. That's like a double whammy.
It is, yeah. The tariffs are a real risk because they could push inflation higher while also slowing down economic growth. Economists at Nomura, they've actually revised their forecast for core PCE inflation. That's the Federal Reserve's favorite way to measure inflation. And they're now predicting it'll hit 4.7% by the end of the year, which is a big jump from their previous 3.5% prediction.
So what does that mean for things like interest rates? We're hoping to see some relief there, but...
Well, higher inflation could tie the Fed's hands. They might not be able to lower interest rates as much as they'd like to normally. Rate cuts can help stimulate a slowing economy, but if inflation's high, the Fed might have to keep rates higher to try and control prices, and that could lead to what economists call stagflation, which is basically slow growth and high inflation at the same time.
And that's bad.
Right? It's a really tricky situation because the tools you'd normally use to fix one problem can actually make the other problem worse. Raising interest rates might help with inflation, but it could also slow down the economy even more, potentially leading to job losses, which would obviously hurt a lot of people.
So it's not just about prices and investments, it's also about jobs. And we've had pretty low unemployment recently, but
Right. Unemployment's been low, but we have seen some signs that employers are starting to hire less, and an economic slowdown caused by these tariffs could definitely make that worse, lead to even slower job growth, and people are definitely feeling anxious about this. A recent University of Michigan survey found that two-thirds of people expect unemployment to go up in the next year. That's the highest percentage since 2009, so there's definitely a lot of unease out there.
so given all this uncertainty, what can our listeners do to prepare? It can feel really overwhelming. So let's try to focus on some practical steps for building some financial resilience.
Yeah, absolutely. That's the key question. And in times like these, building a strong financial foundation is more important than ever. One of the first things financial professionals usually recommend, and I'm sure John White at Financial Guidepost would agree, is to focus on reducing debt, especially high interest debt like credit cards. Freeing up those resources can make a big difference.
Makes sense. Less money going to interest payments means more flexibility in your budget. So what else should people be thinking about in terms of their immediate financial situation?
Well, building up your emergency savings is really crucial. Lizetta Rainey Braxton, who's a financial planner, she talks about the importance of having a cash cushion account, something to give you stability and the ability to handle unexpected expenses. Or if your income takes a hit during these uncertain times, aiming for 3 to 6 months worth of living expenses is a good rule of thumb.
So what about longer-term goals like retirement? Should people be freaking out about their retirement savings right now?
For people who have a while before they retire, the advice is basically stay the course, keep making those regular contributions to your retirement accounts. Market downturns, while scary, can actually be opportunities to buy investments at lower prices, which can benefit you in the long run. You know, retirement savings, it's a marathon, not a sprint.
Right.
So don't panic, just keep contributing consistently.
So we talked about strengthening our finances. What about day-to-day spending? Are there any specific strategies that consumers should be thinking about right now?
Yeah, I mean, it's going to be important to be more selective with your purchases. It might be tempting to rush out and buy stuff you were already planning to get just to try and beat the tariffs. But be careful about making big, unplanned purchases just for that reason, especially if it's going to strain your budget. Really think about whether that potential future price increase is worth the risk of taking on more debt now.
So maybe don't go crazy buying stuff in bulk just because you think the price might go up later.
Exactly. And comparison shopping is going to be more important than ever. Matt Schultz from LendingTree, he stresses the importance of doing your homework, comparing prices across different retailers before you buy anything, as he puts it. Failing to do your homework and comparison shop can make an already challenging situation that much worse. So, a little bit of effort can go a long way.
That's good advice. And beyond just individual purchases, how should people be thinking about their overall household budget and finances?
Well, flexibility is key. Be prepared to adjust your spending as prices change. Keep a close eye on your household expenses and see where you might be able to cut back if you need to. Maybe cutting out some non-essential stuff or finding cheaper alternatives for things you use every day. Regularly reviewing your budget maybe once a month can really help you stay on top of things.
Okay, so let's talk about investments because it's been a pretty wild ride for investors lately. What's the best way to approach this kind of market environment?
Well, the most important thing is to keep a long-term perspective. Lisa A. Kerbauer, who's a financial advisor, she reminds us that market fluctuations are often just background noise in the grand scheme of things. Staying invested and making strategic adjustments instead of just reacting emotionally is usually the better strategy in the long run. Trying to time the market, buying low, selling high, that's really hard to do even for professionals.
So basically, don't panic sell when the market drops.
Exactly. Diversification is still key. Having a good mix of different assets in your portfolio, things like U.S. stocks, international stocks, bonds, maybe even real estate. Different asset classes react differently to economic events, so diversification can help cushion the blow if one part of the market takes a hit.
And for people who are investing for the long haul, like for retirement, what's the main takeaway?
Well, John Anderson, who's a certified financial planner, he advises against selling off your investments during market downturns, especially if you have a long time before you need to use that money. Remember, market downturns are normal. They happen, and historically, markets have always recovered. So selling when prices are low can lock in your losses, and it might prevent you from benefiting from future gains.
We've talked a lot about individual consumers and investors. What about businesses? Are there any broader strategies that they might be considering in response to these tariffs?
Yeah, businesses are having to adapt too. They're probably reevaluating their pricing strategies to figure out how to adjust prices while still staying competitive. And a lot of them are taking a close look at their supply chains to explore different sourcing options, maybe finding suppliers domestically or in countries that aren't subject to the tariffs. And they're probably also reviewing their contracts with suppliers and customers to make sure they have some flexibility if costs suddenly spike.
So it sounds like pretty much everyone's going to be affected by this in one way or another.
Yeah.
Yeah, it really looks like we're in for a period of significant economic adjustment. And while we don't know exactly how everything's going to play out, it seems pretty clear that both consumers and investors should be prepared for some big changes in the coming months. We're likely to see prices go up on a lot of things, and there's a real possibility of more market volatility and slower economic growth.
So the key message is be prepared, don't panic,
Hmm.
focus on strengthening your personal finances and think long term when it comes to your investments.
Exactly. And as Josh Stillwagon warned, a significant concern is that this may not just be a one-time price surge. This could be something that has a lasting impact. So we all need to be adaptable and build up that financial resilience.
That's definitely something to keep in mind. So for you, the listener, we really encourage you to think about how these potential economic shifts might affect your long-term goals.
Hmm.
What parts of your budget or your investment portfolio need a closer look right now? Maybe it's time to do some planning, maybe some research. Financial Guideposts is a great place to start and really think about how to navigate this changing economic landscape. Thanks for joining us for this deep dive,
It's been a pleasure.
and we'll see you next time.
See you then.